The world watched in horror as the global financial system, the very engine of modern civilization, ground to a violent halt. Trillions of dollars vanished, 30 million people were pushed into unemployment. 50 million fell below the poverty line. But here's the kicker. This wasn't a natural disaster. It wasn't an accident. This was a heist, a calculated systemic theft executed by the smartest people in the room. This is the story of an inside job. To understand how the world burned, we first have to look at a small island in the North Atlantic, Iceland. For decades, Iceland was a boring, stable country with zero unemployment and a perfect social safety net. But in 2000, the government decided to try a dangerous experiment. They deregulated their 3 largest banks. Imagine taking a quiet neighborhood and turning it into a high-stakes Las Vegas casino overnight. That's exactly what happened. These 3 tiny banks, which had no experience in international finance, started borrowing money like there was no tomorrow. In just 5 years, they went from having almost nothing to owning assets worth 10 times the entire GDP of Iceland. The bankers became rock stars. They bought private jets, London mansions, and even hired Elton John to play at their birthday parties. But there was a catch. They weren't creating wealth. They were creating debt. You might ask, why did the world lend them so much money? Enter the rating agencies. Firms like Moody's and Standard & Poor's gave these Icelandic banks AAA rating, the highest possible score. It meant these banks were as safe as the US government, but it was a lie. When the bubble finally burst in 2008, the banks collapsed in weeks. Unemployment tripled. The currency lost half its value. The people of Iceland lost their life savings, while the bankers, the ones who caused it, walked away with their bonuses intact. What happened in Iceland was a microscopic version of what was happening in the United States. While Iceland was the laboratory, Wall Street was the factory. In the next part, we dive into the heart of the beast, the American housing bubble. We'll see how a simple mortgage was turned into a weapon of mass financial destruction. Narrator punchy outro. The bankers didn't just break the law, they rewrote it. Stay tuned. Segment: the securitization food chain. To understand the 2008 crash, you have to understand how the American dream was weaponized. Back in the day, banking was boring. If you wanted to buy a home, you went to your local banker. He gave you a loan, and you paid him back over 30 years. Because the bank held your loan, they were careful. They made sure you had a job, a good credit score, and a soul. If you didn't pay, the bank lost money. Simple, right? But in the late 90s, Wall Street changed the rules. They created a securitization food chain. Now, when you get a mortgage, the local lender doesn't keep it. They sell it to an investment bank, like Lehman Brothers or Goldman Sachs. These banks take thousands of mortgages, good ones, bad ones, and downright ugly ones, and bundle them together into a financial box called a CDO, collateralized debt obligation. Here is where the magic or the crime happens. Wall Street takes these bundles of debt and sells slices of them to investors worldwide, pension funds, insurance companies, and even your local city council. But wait, why would a smart investor buy a box filled with risky loans? Because of the rating agencies. Moody's and S&P were paid millions by the banks to put an AAA stamp on these CDOs. It was financial alchemy. They took subprime trash and turned it into investment-grade gold. Since the banks were no longer at risk if the homeowner defaulted, they stopped caring about the quality of the loans. They just wanted volume. Lenders started giving out subprime loans. These were targeted at people who couldn't afford them. No income, no job, no assets, no problem. They called them NANJA loans. The more loans they sold, the more boxes Wall Street could build, and the more billions in bonuses the CEOs could pocket. This wasn't just bad business, it was predatory. Lenders were literally pushing people into loans they knew would fail. Why? Because the securitization food chain acted like a giant pump. As long as house prices went up, the music kept playing. But Wall Street knew the music was about to stop. In fact, some of them were already building a bomb shelter while selling everyone else fireworks. By 2005, the housing bubble was the biggest in history. Trillions of dollars were tied to these trash-filled boxes. But Wall Street had one more trick up its sleeve to make even more money when everything eventually exploded. It's called a credit default swap, and it's the most dangerous bet ever made in human history. Segment: the big bet credit default swap CDs. By 2006, Wall Street wasn't just a financial hub anymore. It had become the world's largest unregulated casino. And the game of choice was something called a credit default swap, or CDs. Think of a CDS as an insurance policy. If you own a house, you buy insurance so that if it burns down, the insurance company pays you. Simple, but Wall Street added a dark twist. It allowed people to buy insurance on other people's houses. The biggest seller of this insurance was a company called AIG. Specifically, a small unit in London called AIG Financial Products. They realized they could collect billions of dollars in premiums from banks by promising to pay up if those mortgage boxes CDOs ever failed. Because house prices had always gone up, AIG thought they were collecting free money. They didn't even set aside any cash to pay out if things went wrong. They were essentially selling fire insurance while the neighborhood was already soaked in gasoline. This is where it gets criminal. Banks like Goldman Sachs realized the housing market was a ticking time bomb. So what did they do? Did they warn their clients? No. They did two things. Asterisk. They kept selling trash. CDOs to unsuspecting investors like pension funds for teachers and firefighters. At the same time, they went to AIG and bought billions of dollars in CDS insurance against the very products they were selling. It's like a doctor selling you a health tonic that he knows is poison and then taking out a massive life insurance policy on you. It got even crazier. They created synthetic CDOs. These weren't even made of actual mortgages. They were just side bets on other mortgages. Suddenly, for every $100,000 house, there was $1 million worth of bets placed on it. The bubble wasn't just in the housing market anymore. It was a giant web of trillions of dollars in bets that no one, not the government, not the regulators, was tracking. There were people who saw this coming. Brooksley Born, a top regulator, tried to warn the government that these swaps needed to be regulated, but she was shut down by the untouchables. Men like Alan Greenspan and Larry Summers, they argued that the market knows best. They passed laws that made it illegal to regulate these derivatives. They literally cleared the path for the disaster. By late 2007, the first cracks appeared. Homeowners stopped paying. The trash boxes started to rot. And Goldman Sachs and other big players started demanding their insurance money from AIG, but there was one problem. AIG didn't have the money. And if AIG fell, they were taking the entire world with them. By early 2008, the gold mine had turned into a minefield. The first major casualty was Bear Stearns, the fifth largest investment bank. They ran out of cash in days. The government stepped in and forced a fire sale to JP Morgan. Wall Street thought the Bear Stearns bailout was the end of it. They were wrong. It was just the opening act. The rot was deeper than anyone dared to admit. September 2008, the spotlight turned to Lehman Brothers. For 158 years, Lehman had survived civil wars and world wars, but they couldn't survive their own greed. Lehman was carrying billions in toxic real estate debt that no one wanted to buy. Their stock price was in a free fall. The CEO, Dick Fuld, waited for a government bailout that never came. Friday, September 12th, the heads of every major Wall Street bank were summoned to the New York Federal Reserve. The message from Treasury Secretary Hank Paulson was clear. Fix this. There will be no government money for Lehman. Can't. All weekend they scrambled. Barclays wanted to buy Lehman, but the British government said, no thanks. We don't want your American trash. Bank of America looked at Lehman, did the math, and ran away buying Merrill Lynch instead, just to stay alive. Monday morning, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in human history. The global financial system froze. Why? Because every bank in the world was connected to Lehman. It was a giant game of dominoes. If Lehman didn't pay Bank A, then Bank A couldn't pay Bank B within hours. The plumbing of the world economy stopped working. Banks stopped lending to each other. They were too terrified to move. But wait, it gets worse. Remember AIG? The company that sold the insurance CDS on all that debt? Because Lehman failed, AIG now owed billions in payouts that they didn't have. If AIG went bankrupt, every other bank, Goldman Sachs, Morgan Stanley, Deutsche Bank, would lose billions instantly. It was a financial nuclear bomb. This time, the government blinked. They realized if they didn't save AIG, the global economy would literally disappear by Wednesday. On Thursday night, Hank Paulson and Ben Bernanke met with congressional leaders. The message was terrifying. If you don't give us $700 billion by Monday, the world economy will collapse. It wasn't a request. It was a ransom note. And the American taxpayer was about to pay the bill for a party they weren't even invited to. The U.S. Treasury Secretary, Hank Paulson, man who, ironically, was the former CEO of Goldman Sachs, told Congress they had no choice. They called it TARP, Troubled Asset Relief Program. The pitch was simple. Give the banks $700 billion of taxpayer money so they can start lending again and save the economy. October 13th, 2008, Paulson summoned the CEOs of the 9 largest banks to the Treasury Department. He didn't ask them. He ordered them to take the money. But there was a massive flaw. The government gave them the money with no strings attached. No requirement to help homeowners. No requirement to stop foreclosures. And most importantly, no requirement to stop paying themselves. You'd think that after destroying the world economy and needing a taxpayer rescue, these guys would be a little humble. You'd be wrong. In 2008, the same year the world collapsed, Wall Street banks paid out $18 billion in bonuses. Think about that. They failed at their jobs, lost trillions of other people's money, were saved by the public, and then rewarded themselves with billions. At AIG, the company that required a $180 billion bailout, they paid out $165 million in bonuses to the very financial products unit that caused the collapse. It wasn't just greed. It was an insult. While the public was focused on the auto CEOs being yelled at for their private jets, the Wall Street elite was quietly moving back to business as usual. The banks used the bailout money to buy up smaller banks, becoming even larger and more too big to fail than they were before the crisis. The predator didn't die. It just grew a second head using your tax dollars. Why was the government so generous? Look at the names. Hank Paulson, Treasury Secretary, former CEO of Goldman Sachs. Asterisk. Timothy Geithner, NY Fed President, later became Treasury Secretary. Larry Summers, top advisor, made millions consulting for hedge funds. The regulators and the regulated were the same people. It's a revolving door. How do you punish your friends, your former bosses, or your future employers? You don't. You bail them out. But the corruption didn't just live in the banks and the government. It had a secret home in the most respected places in the world, the universities. When we think of corruption, we think of shady backroom deals or suitcases full of cash, but the most dangerous kind of corruption happens in the classroom. To keep the Wall Street machine running, the bankers needed more than just money. They needed credibility. They needed the world to believe that deregulation was good and that the housing bubble was stable. To get that, they bought the smartest minds in the world. Meet the academic elite. Men like Glenn Hubbard, the dean of Columbia Business School, and Frederick Mishkin, former Federal Reserve governor. These men weren't just teaching students. They were making millions as consultants for the very banks and hedge funds they were supposedly objectively analyzing. Remember the Iceland collapse from part 1? 2 years before the crash, Frederick Mishkin was paid $100,000 by the Icelandic Chamber of Commerce to write a report. His conclusion? Iceland's banks were stable and vibrant. When the movie's director, Charles Ferguson, asked Mishkin about it, and Mishkin couldn't even remember the title of his own paper. On his CV, he had changed the title from financial stability to financial instability. It wasn't a typo, it was a cover-up. The tension in the film peaks when the director confronts Glenn Hubbard. Hubbard was a chief architect of the Bush administration's economic policy and a huge supporter of deregulation. When asked about the massive payments he received from financial firms, Hubbard snapped. He told the director, "You have 5 minutes. Give it your best shot." These professors use their Ivy League prestige to sell policies that benefit their donors, all while claiming academic freedom. They provide the intellectual map that leads the world off a cliff. In medicine, if a doctor is paid by a drug company to test a pill, they have to disclose it. It's the law. But in economics, there were no rules. You could be paid by Lehman Brothers to say Lehman Brothers is great, and no one would ever know. The system was designed to be opaque. The experts were actually part of the sales team. While the professors were collecting their consulting fees and the bankers were collecting their bonuses, the real world was starting to bleed. The inside job wasn't just a financial failure. It was a human catastrophe. Next, we look at the victims. The people who lost everything and the dark reality of what happens when the global village burns down. While Wall Street was busy calculating its bonuses, millions of people were calculating how many days they had left before being kicked out of their homes. This wasn't just a market correction. This was an eviction of the middle class. Between 2008 and 2010, over 6 million Americans lost their homes. In places like Las Vegas, Florida, and California, entire neighborhoods became ghost towns. Families who had worked for 30 years to build equity saw it vanish in 30 days. For the first time since the Great Depression, tent cities began to pop up across the United States. These weren't people who were traditionally homeless. These were teachers, construction workers, and office managers. They did everything right. They went to school, got jobs, and paid their taxes. But they were the collateral damage of a war fought with spreadsheets and synthetic bets. The inside job didn't stop at the US border. Because the world's banks were all holding those trash-filled boxes, CDOs, the collapse went global. In China, 10 million migrant workers lost their jobs as export demand evaporated. In Germany, the engine of Europe, the economy shrank at its fastest rate since World War II. In developing nations, the crisis pushed an additional 50 million people into extreme poverty. One of the most permanent scars of the crisis was the death of industry. Banks stopped lending even to healthy companies. Small businesses couldn't get credit to buy inventory, Iconic American companies were pushed to the brink. Manufacturing jobs that had supported families for generations were outsourced or simply erased. The financial sector had become a parasite that was now killing its host, the real economy. You can't put a price tag on the psychological damage. Stress, depression, and the loss of dignity. Suicide rates spiked globally. The social contract was broken. The message from the government was clear. If you are a billionaire banker, we will save you. If you are a hardworking citizen, you are on your own. But the crisis didn't just hurt the elderly and the middle-aged, it set a trap for the next generation. As the economy crumbled, the cost of education skyrocketed, and the job market disappeared. By 2010, Wall Street was back. Stocks were hitting new highs, and profits were soaring. But if you walked down any main street in America, it felt like the recession never ended. This was the K-shaped recovery. The people at the top got a life jacket and a yacht. Everyone else was told to learn how to swim in a storm. The wealth gap didn't just grow, it exploded. For the first time in history, the middle class was no longer the majority. Remember the goal of the bailout? It was to stabilize the system. But it did something else. It killed the competition. Before the crisis, there were dozens of major players. After the crisis, the big four banks, J.P. Morgan Chase, Bank of America, Citigroup, and Wells Fargo became so massive that they controlled more of the economy than ever before. They weren't just too big to fail anymore. They were too big to regulate. Here's the most bitter pill to swallow. Not a single high-ranking Wall Street executive went to jail for the fraud that led to the 2008 crash. Not one. The Justice Department, led by Eric Holder, argued that prosecuting these giant banks could destabilize the economy. It was a new legal doctrine, too big to jail. If you steal $100 from a liquor store, you go to prison. If you steal $100 billion from the global economy using complex math, you get a federal subsidy and a seat at the White House dinner table. In 2010, the government passed the Dodd-Frank Act, promised to be the toughest financial reform since the Great Depression, but behind the scenes, an army of 3,000 lobbyists, 5 for every member of Congress, spent millions to gut the bill. They made sure the most dangerous practices, like the dark pools and over-the-counter derivatives, remained largely unregulated. The watchdogs were given muzzles, and the wolves were given the keys to the sheepfold. To keep the system from collapsing again, the Federal Reserve began printing trillions of dollars, a process called quantitative easing. This kept interest rates at zero. Who did this help? Not the person with a savings account. It helped the big banks and hedge funds borrow money for free to buy up real estate and stocks, driving prices even higher. The recovery was built on a new bubble, fueled by the same people who popped the last one. As the cost of living went up and wages stayed down, the next generation began to realize they had been robbed of their future. The anger was simmering. The promise of the West was simple: work hard. Follow the rules, and you'll get ahead. But after 2008, that promise was dead. People realized the rules were only for them, not for the untouchables. This realization ignited a global fire of anger that would change politics forever. In September 2011, a small group of protesters occupied a park in the heart of the financial district. They were the 99%. They weren't just protesting poverty. They were protesting injustice. They saw that the bankers who caused the crash were now richer than ever, while the youth were saddled with record-breaking student debt and a gig economy that offered no security. The movement was evicted by police, but the message was out. The system is rigged. When the center fails to deliver justice, people move to the edges. The 2008 crisis paved the way for a new kind of politics, from the Tea Party to Brexit, and from the rise of nationalist leaders in Europe to the polarization of America. The root was the same. People felt abandoned by the elites. They felt that the globalized financial system was a machine designed to drain their wealth and ship it to offshore bank accounts. While governments told their citizens they had to tighten their belts austerity, the wealthy were moving their money into the shadows. Trillions of dollars, roughly the size of the US and Japanese economies combined, are hidden in tax havens. This is money that isn't being taxed, isn't being invested in schools, and isn't being used to fix the infrastructure. The inside job wasn't just a one-time heist. It was the creation of a permanent, borderless, wealthy class that doesn't have to play by the rules of any nation. Perhaps the saddest cost of the inside job is the waste of human talent. For 30 years, the brightest minds from Harvard, MIT, Stanford have stopped going into science, medicine, or engineering. Instead, they go to Wall Street. Why? Because that's where the money is. We have the smartest people on the planet spending their lives building algorithms to shave a microsecond off a stock trade, rather than curing cancer or solving climate change. The financial sector has sucked the brainpower out of the rest of the world. As we look at the world today, we have to ask, is it over? Or was 2008 just a dress rehearsal for something even bigger? After the 2008 crash, The world expected a new deal. We expected a cleanup. But when the smoke cleared, the new administration looked a lot like the old one. President Obama, who campaigned on change, appointed the very people who helped deregulate the system to fix it. Timothy Geithner, who was at the NY Fed during the collapse, became Treasury Secretary. Larry Summers, who lobbied against regulating derivatives, became a top advisor. It was like hiring the foxes to rebuild the hen house after they'd already eaten the chickens. Today, the financial industry is more concentrated than ever. The biggest banks, the too big to fail group, are now 30% to 50% larger than they were before the crisis. If one of them falls today, the impact won't just be a recession. It will be a global blackout. We haven't fixed the problem. We've simply made the bomb bigger and the fuse shorter. We have to address the elephant in the room: accountability. In the savings and loan crisis of the 1980s, over 1,000 bankers went to jail. In 2008, instead, the banks paid fines. But here's the secret: the banks paid those fines with shareholder money, not the CEO's personal fortunes. It's the equivalent of a bank robber being caught and punished by having to give back 10% of the loot while keeping the rest and a get-out-of-jail-free card. What did Wall Street learn from 2008? They learned that they are the untouchables. They learned that if they take massive risks and win, they keep the profits. If they take massive risks and lose, the taxpayer picks up the bill. In economics, this is called moral hazard. In plain English, it's a heads I win, tails you lose scam. And as long as that system exists, another crisis is not a possibility, is a mathematical certainty. Inside Job isn't just a movie about a financial crisis. It's a movie about the erosion of the social contract. It's about a world where wealth is no longer a reward for productivity, but a reward for financial engineering and political connections. The people who broke the world economy are still out there. They're still running the banks, still advising the governments, and still teaching in the universities. The heist of the century didn't happen in a dark alley. It happened in broad daylight, in the most prestigious offices in the world. And the most terrifying part, no one stopped them. And no one is stopping them now. This was an inside job, and you're still paying for it.